Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is Wednesday, September 3rd, 2025. So we're going to cover the market insights. I'm going to begin with the dashboard, which is the 6 U.S. indexes and the equity indexes and the long-term government bond. So when you look at the yellow box in the center, that gives you what happened last week. And you can see from all of those, with the exception of a little bit of gain out of small cap, they were all negative, including bonds. The red box gives you the year to date. All of those are positive except bonds, long-term government bonds. So going from a 20% rate of return year to date down to a 6%. Now, I want to remind you, this is not an annualized number. This is an actual number. We are about 2/3 of the way through the year. So this would be about 50% higher if it continued at the same rate through the end of the year. On the far right, green dots, red dots. Green dots are above the 20, 50, 100, and 200-day moving averages, and the red dots are below. At the very bottom, TLT, the long-term government bond, is negative. Below, it's all 4 moving averages. The S&P 500 has 11 major industry sectors in it. These are all 11. They're listed on the left, and to the far left are the ticker symbols for the ETFs for those sectors. Well, for this purpose, the sectors were mixed. Some of them were negative for the last week, some were positive. When you get to the red box, just to the right of center, they are all positive year to date, from a 17% rate of return all the way down to almost nothing. To the far right are these same green and red dots above and below moving averages. You can see that 5 of the 44 are negative, below their moving averages, and meaning 39 out of the 44 are above their moving averages. The S&P 500 that we're working with, this is a 3-year chart, and it's a weekly chart. So one move in this equals 1 week. For 3 years, almost 3 years, it has a clear upward trajectory, and I put the black arrow to show that. It's still well above its 20-period moving average, illustrated here. And there is no correction. The correction that was going to happen happened during the first quarter, mostly in February and March and the first week of April. And you see that at the far right. And after that correction, it took off. The reason for that correction mostly was the introduction of tariffs. And so those were being announced frequently. We're going to have a tariff on this country and this country and this country. And seemingly every day or two, there was an announcement of a potential tariff. Nobody knew how to interpret that. Does that mean that things are going to slow down in our economy, or we were focused on ours, not so much theirs, and but we didn't know how to interpret it. So you see the drop in that, and then I think there was kind of some clarity around it, and the market took off in the second week of April, and here we are. So it's just gone kind of straight up since that period of time. When I convert this over to a candlestick chart, same thing, same movement. It just gives you some detail around, is this, the red representing a down week, and the the hollow candlesticks representing usually an up week. I took that 3-year chart and compressed it into a year-to-date chart. So here we have from the beginning of January to present. Still have that drop. Now it's more magnified. You can see it. And that occurred mostly in, as you can see, second half of February, definitely March, and then the first week in April. This is a relative strength chart showing the NASDAQ 100 relative to the S&P 500. So when, and the NASDAQ 100 is the numerator. So when it goes up, this means that it favors the NASDAQ 100, and when it goes down, it favors the S&P 500. At the very far right, upper right, you see the drop, and that means that the NASDAQ 100 relative to the S&P was out of favor. And so, but the long-term trajectory over that 3-year period has been upward. Same thing here, this is growth versus value. So if we look at just growth versus just value type stocks of the S&P 500, we still have that pullback at the very far right, and we still have a long-term trajectory upward. Now, when we compare the S&P 500, this is where a bigger divergence happens. The S&P 500 to the IWM, which is the small cap Russell 2000 small cap index, the Russell 2000 did quite well in the last couple of weeks, 2 weeks, 3 weeks, relative to the S&P. To the extent that you see that dropping below its 20-period moving average. And then I put a black arrow showing kind of the general direction, short-term direction. This is more like about a 3 or 4 month period of time, meaning that small cap has been more in favor than large cap. Bonds continue to do poorly, long-term government bonds. So any type of high-quality bond, whether it be the government bonds or high-quality corporate bonds, they are all moving in a downward direction and have, this is a 5.5-year chart, been moving generally in a downward direction. And that makes up a lot of traditional portfolios, buy and hold portfolios, stock and bond portfolios. And this, if it's a 60-40, this or something like it, corporate bond or government bond, is the 40%. It does not, if you have a buy and hold 60-40 stock bond portfolio, you know what I'm talking about. Returns over the past several years have been anemic, not very attractive. I took this from a 5.5-year chart and compressed it to a 1.5-year chart, and I put it on a candlestick basis. So even the longer term is downward, and even the last 12 to 18 months is also moving in a downward direction. What that means is that interest rates and bond yields are going up, which is forcing bond prices to come down. The dollar, since the beginning of the year, has struggled. It was doing well up to that point. Since that time, it is down. What it means is foreign individuals or countries who are buying or investing in the U.S., their currency goes further. And when we are buying or investing in foreign countries, our dollar doesn't go as far as it did. Gold has been on a tear. It's just been going up and up and up. You can see that fairly consistently. A good week, you can see at the very upper right for gold, up now above 3,500. And as of this morning and today, both silver and gold are up again, up nicely again. So it just seems like it's unstoppable. Silver, again, you can see that move at the very end, moving up very nicely. It's been more choppy. It hasn't had the consistency that gold has, but when it moves up pretty dynamically, and that's what's happening right now. Bitcoin, definitely a down week for Bitcoin, and but overall in that 3-year period, it's moved up. Volatility went up a little bit, nothing significant, and but still, the black arrow gives you the direction that it is moving down, because equities have generally been moving up, which causes the volatility index to come down. South Korea, I'm using this as a proxy for foreign markets, EWY, measured against the S&P 500. It gives you a good, we could compare the U.S. market, S&P 500, against a lot of foreign markets. But this gives you, in my opinion, a good proxy for that. Gold and silver, as I said, gold moved up. It went up 0.8% for the week, up to 34.48. This morning it's nicely above 3,500. Silver closed at 39.99 last week, and then the aftermarket went above 40, and I believe as of today it's above 41, up 2.4%. Over the previous, this is Friday to Friday. Gold silver ratio 86-1, making silver still a better buy. Now, I want to mention a couple of things here. I buy silver. I am one of very few, it seems, very few financial advisors in the country that believe in this. I talk to people all over the country, and they say to me, "You're the only guy I've ever talked to who believes in buying silver or gold." And I think the reason is because most of them are commission-based, about 85% based on data that I've seen are commission-based, and they want commissions on things they sell. And they don't sell gold and silver, they want to sell stocks and bonds and mutual funds for which they get a commission. There's nothing wrong with commissions. You know, if you buy a car or you buy furniture or a house, somebody's going to get a commission. But when you invest money, if somebody is paid a commission, that comes out of your money, and then they amortize it over time. But I don't believe in taking commissions. I think that's not correct for the consumer. I wouldn't want it done to me. And but I am a buyer of gold and silver. And by the way, when you buy gold and silver, you do pay a commission, and but pay it to the retailer. You can only buy it from a retailer. You cannot buy it from a wholesaler. And so you get in the pricing of gold and silver. What I'm showing you here is I'm showing you what is called the spot price. This is not really a wholesale price. It's just the excuse me, the price that it's marked at internationally. And on top of that, there is a commission. I have been buying silver. I bought some gold originally, excuse me, back in the 80s and early 90s, and then I've been buying silver ever since. And I'm still buying. This week I'm buying. So if you have money that's available in a taxable account, I buy it because not it's a great investment, although it actually has been a great investment. I buy it because it's an insurance policy against the decline of the dollar. When you go back historically to societies and empires that have existed for thousands of years, all the paper currency has gone away, and the only thing that's existed that has continued to exist is gold and silver. And it's not only existed, it has maintained its value, whereas the value of paper currency has declined a lot. Those that are still around would be like the U.S., the U.K., German countries, and they have paper currency. Most of them, ours is worth about 5 cents on the dollar over since inception, which was 1913, inception of the Federal Reserve. And I think the UK is worse than ours. They were probably somewhere between 95 and 99% decline. And but meanwhile, the value of gold and silver have gone up exponentially, and they have preserved the value of those currencies. Now, it would be nice if we could just do everything in gold and silver, but you can't. You can't take an ounce of silver into the grocery store and buy groceries, or to buy gasoline with it. And if you wanted to buy a car, you can't take a few ounces of gold and go buy the car. It just doesn't work that way. So I do this in order to preserve that, and hopefully I won't need it. But I'm continuing to buy it because I think it's continued to be a good value. When I first started, silver was around $8 an ounce. Today it's 41. Gold at that time was around $400, and now it's about $3,500 an ounce. So definitely gone up a lot in value. But the main point is that they have retained their buying power. So what does $3,500 in an ounce of gold buy you today? About the same that $400 an ounce bought you 35 years ago. That's how it works. It's buying power. This next week, I am going to Nashville to be with my son Preston. He is a precious metal dealer there in the Nashville area. Very proud of him. He's done very well. Amazing prices. I've said that before because he has very, very low overhead, and he beats all the big names on the internet in prices. And he does it because he just doesn't have to pay out for advertising and salaries and so forth. So that has made it a good business for him very quickly. He and I are going to the International Money Exchange show in Nashville at the Convention Center the latter part of the week. So I look forward to that, look forward to being with him, and it'll be a lot of fun. Of course, there'll be a lot of dealers there, and there'll be a lot of people, looking at, buying or selling gold and silver. So I will report to you next week on that and how it went, but I look forward to it. Okay, back to silver. A monster box of silver bullion, which is 500 ounces of approximately pure silver, $19,665. And the data that I've looked at, and I'm checking with Preston, making sure this is correct for him, but I believe it is that the retail, including the commission, is below the spot price. Very rare, but that's a function of supply and demand. So, that means he's buying it below spot price. And then whatever that differential is for the net commission, he shares that with the wholesaler. That's how that works. Okay, thank you for watching. If you have questions or comments, leave them in the comments section below.